South Africa's public debt is rising at a much faster pace, but the economy is growing at a much slower pace. That's according to the Finance Minister Enoch Godongwana. Earlier today in Cape Town, he delivered a pretty sobering assessment of the country's public finances as he tabled the medium-term budget policy statement. It essentially gives an overview of revenue and expenditure forecasts over the next 3 years. CGTN's Sumitra Naidu has the numbers.
The Finance Minister said South Africa has been spending more than its revenue since the 2008 financial crisis. Gross debt to GDP is only expected to stabilise at 77% in the next 2 years. In the meantime, the budget deficit has grown substantially, while growth for 2023 has been revised lower to 0.8% from the Treasury's previous forecast of 0.9%.
As a result of gross debt rising from 4.8 trillion in 2023-24 to 5.2 trillion in the next financial year. By 25-26, it will exceed 6 trillion mark.
Paying for this debt over the next 3 years will cost the state $69 billion, which means cutting back on budget allocations.
Our challenge is that the rising debt service costs are crowding out important social spending, and our economy has not grown fast enough to support increasing expenditure or our current debt levels.
The minister noted the severe impacts of the Eskom and Transnet crises on economic growth. He said the economic consequences of rail underperformance alone cost the economy up to 5% of GDP, with losses in the region of $2.5 billion in the mineral sector.
Unfortunately, it is very difficult to firstly increase your tax base because people are getting more and more unemployed. With a very low commodity prices in the mining sector, it means that your tax collections from a corporate tax perspective are also limited. So this also pushes the minister on the back foot.
I think his approach is to assist these SOEs to be able to access private funding. And so I expect him to put Transnet in a position whereby, from a borrower's perspective, lenders can look at it favorably and give it money, as he did with Eskom.
The minister referred to his policy statement as government strategy to avoid a fiscal crisis. He said there would be a review and reconfiguration of the state structure, all government departments and state-owned entities over the next 3 years in order to prevent systemic risks to the South African economy. Sumitra Naidu, CGTN, South Africa.
All right, then let's dive into the details of the medium-term budget policy statement. Professor Patrick Bond is a distinguished professor of sociology at the University of Johannesburg. He's also a political economist and is joining us on the program at the moment. Thank you for your time, Professor Bond. So a $3 billion, roughly 56 billion rand miss on the tax target for the year. That's a pretty big one. Other than the slump in commodity prices, PGM prices have been essentially in free fall so far this year, plus the country's power crisis. What else explains the fact that revenue targets are so far off target?
Well, we've also had the load shedding, and so that's been the electricity crises that have been worse this year than ever in history. And in addition to that, those mineral products, which you're right, there was a commodity crash from about mid-2022. Those commodity prices were really unreasonably high. So when they've come down, it's also been amplified by the train system, Transnet's inability, especially to run coal from the coal fields out to the Richards Bay port and to some extent the iron ore. So those big commodities haven't been moving, and I think that's really one of the key factors is our Eskom and our Transnet, our state-owned enterprises, have been run into the ground. They're not working very well. So that really has hit the revenue inflows.
Indeed. And investors, of course, have been long concerned, right, about South Africa's public debt rising to essentially unsustainable levels because the average yield now on the country's bonds is 9.5%, at least it was in October. Do you think there's any extra appetite for the extra debt that the Finance Ministry says they're going to issue?
Yes, it's not that much debt, but the main point is that 9.5%, there's really only 3 countries that offer 10-year bonds in the world markets. Those would be Brazil, Turkey, and Pakistan that have higher rates. And I think it's partly because there is a sense that there's a volatile politics here, but also that we've had excessive exchange control liberalization, so money floods out very quickly, and so you have to have high rates to attract it back, and that's a shame. We could have tighter exchange controls, say the way China has done since 2015 on a few occasions has had to tighten up. And so, yes, I think there's an appetite because that's a very good rate of return, isn't it? And we have a stock market that's highly overvalued. The Buffett indicator of capitalization of the stock market to GDP is pretty much the highest in the world over the last few years. And I think there should be some appetite for buying government bonds because there's really no risk of default.
Indeed. I want to go back to something that we spoke about a little earlier. Transnet is a key bottleneck, right, in getting some of these commodities, the coal, the iron ore, flowing into global markets. Yet the finance minister also said, look, I'm not giving Transnet the extra debt, the taxpayer bailout that they're asking for. So what sort of reforms does he intend to happen at Transnet to essentially, get rid of that bottleneck that clearly has been a drag on growth this year?
I know. I think probably what Enoch Godongwana, the finance minister, wants to do is privatize, and it's not going very well. The port privatization has stumbled. Look, it's interesting. I mean, he used to be quite the Marxist. He was a trade union leader of the biggest, most militant union, the metal workers. Once I even taught him Das Kapital. I didn't do a very good job. But I think the main thing is he's desperate and I think looking for any sort of fire sale. And the alternative is these awful big trucks that are coming through South Africa, not only from our own minerals, but from across the region. And it's really ripping up the roads and communities are protesting and blocking the roads. So it's a terrible mess at the moment, with a dysfunctional transport and electricity and increasingly water system. And hopefully there's some money to put some funds into infrastructure to fix it all. But it remains to be seen in February. That's when we'll really know where the details are.
Indeed. One last question related to February, of course. The finance minister is also saying, he's going to raise taxes in a February budget speech. He wants to raise about 15 billion rand. That should translate to around $800 million. But given everything we've discussed, right, economic growth this year is, I think, forecast to be 0.8%. 1% next year. Unemployment is still relatively high. Household spending is quite constrained. Where can he raise the extra taxes?
Oh, I would say from the corporates, because they do have quite healthy balance sheets. Many of them, I mean, a few have gone bankrupt. But look, we had a 52.5% tax rate on corporates in 1992, and it's now down to 27. So were there the political will to put on exchange controls and to tax corporates more and to stop the illicit financial flows, we were put into the gray list in February this year because of lax regulation on finance. We could be doing a lot more, but this is a time when the government's looking to hopefully survive its election challenge next year, and it may not, and therefore it's all up in the air whether they move in a populist direction or continue with pro-corporate policies. Remains to be seen, but it should be critical for whether they win votes or lose some more.